Welcome. Ningetaka nikupe this opportunity. You say hi to our friends here. Na utuambie exactly what you do.
Okay. Yeah, my name is Robert Miano. I'm an attorney licensed here in the US, also licensed in Kenya. I'm an advocate of the High Court of Kenya. I'm also a licensed financial professional. I lead a team called Delta Financial, and what we do is we have come together. We have accountants, we have lawyers, we have nurses, all manner of professionals that are going out there and educating families on how to come up with a plan to build generational wealth and avoid something called probate by setting up things that we call trust funds.
Trust funds.
Yes.
I've heard about trust funds.
Yes.
But I actually, many people here trust.
Yes.
But I would just want to tell us what is trust.
Okay. Thank you so much. Yeah.
Unajua tunaamini kule nyumbani trust ni somebody you trust.
Yes.
I don't know whether that is what you mean.
In fact, the concept of trust originates from that.
Okay.
Originate from that. But essentially, it's a legal arrangement. And it's like setting up a box where you say, I'm going to pass my assets to this box. And then I'm going to appoint someone called a trustee to manage these assets for the benefit of my beneficiaries. So for instance, in most cases, what happens in this country, when people set up trust, what they do is they say, instead of owning my house in my own name, I'm going to have it owned by a trust. And then I'm going to be the trustee when I'm still alive. But in case I pass on, I'm going to have so and so take care of this house for the benefit of my kids. And this trustee will pass over the asset to my kids once they are of age. And that is going to help avoid something that we call probate. Yes.
Awesome. I mean, I've seen actually many families fighting after maybe a husband has died.
Yes.
Labda alikuwa na bibi.
Yes.
Akawa mwingine.
Yes.
And then now the battle starts.
Yes.
I own this, I own that.
Yes.
So you want to tell me now this trust inaweza saidia kumaliza hizo vita?
Oh, kabisa.
Hapa Marekani.
Itasaidia
na Kenya pia.
Kabisa itasaidia.
Yeah?
Your trust itasaidia sana because let me give you a case in point. I know of a couple married, husband, wife, 3 kids. Then the wife passed on. And then the guy decided to marry someone else. And then after some time, the guy passed on. And then there ensued a battle between this second lady and the 3 kids. Now the case went to court. The court ended up ruling that this lady had something in law we call a life estate. She could live in that house until when she passed on. The kids could not believe it. The kids could not believe it. That's why I tell people, if you don't come up with a plan that avoids probate, then the court is going to apply its own rules. Let me explain probate, because people only hear about probate. Probate. What is it? So when someone passes on, there's a court called the probate court. It freezes all your assets. And the reason it's doing that is to make sure, first of all, your debts get paid.
So madeni uko umekufa bro.
I know. Madeni kwanza inalipwa kwanza.
Kenya mtu analipanga madeni akiwa amekufa.
Hata Kenya watu wanalipa madeni. What? But here, here, everything is electronic. So a case in point, let's say somebody relied on Medicaid, when you're still alive.
Yes.
The probate court will make sure, if you have a house, for instance, that house is sold to recover the amount that was spent in paying your Medicaid expenses. And that happens during probate. You see? The second thing is that probate law is state law. What does that mean? If you have assets in Oregon, in Washington, in Kenya, there will be separate probate processes. Which ends up becoming very expensive. That's why I tell people, you can avoid probate. And there are 2 ways. Let me explain. There are 2 ways to avoid this probate process. The first one is when for instance, you have a house and you own that house through a trust. You have a business, you have an adult family home. Then that adult family home, you keep it in a trust. The LLC, you have it owned by a trust. That business, that home will avoid the probate process. That's the first thing. Number 2, you have a mortgage on that house. You're going to think about, if I'm not there, how will that mortgage be paid? That's why it always tells people you can open an account called the Index Universal Life Account with living benefits to make sure that if you're not there, this money will go and offset the mortgage expenses. In that way, your family can continue living, the lifestyle that you introduced them too, even if you're not there. Yeah.
Let's come back to the trust.
Yes, yes.
I've seen in a situation whereby somebody dies,
Yes.
and then I mean, I don't know what people sue.
Yes.
Unakuta mtu hajazikwa mwaka.
Yes.
The property was yours.
Yes.
Lakini sasa wengine wanasema kwanza hazikwi. Have you seen something like that?
Yeah.
So hii trust unaweza andika inakuwa na will pia.
Oh, that's a good question. Good question.
That's where I was coming.
That's a good question. There's a difference between a will and a trust. A will goes through probate. A trust does not. In essence, a will is only effective when someone passes on. A trust is effective when someone is still alive.
Okay.
That's why I always talk about the living package. Things that can help you when you're still alive. And the living package consists of a living trust, living benefits, and a living will. Let me explain the three of them.
Right.
Living trust is the same concept, but this living trust is effective when you're still alive. So instead of owning your house in your own name, you own it through a living trust. Then living benefits is to say, if you fall sick, you can't work, you can have an account that will replace your income.
Okay.
So it's a life insurance policy with living benefits. They go hand in hand. So that in case you fall sick, now there's some money that can keep you. Now, living will is you saying, in case I'm in a terminal condition, or maybe irreversible condition, I want to be allowed to die peacefully. Or maybe I want doctors to try as much as they can to save my life. So the living package, some of these things is not when someone passes on, is also effective when you're still alive. Yeah.
Wow. Yeah. You know, in our culture, many people don't want to talk about death. I mean, I don't want to write a will because ni kujidhedha. Inaitangwa, what do you call it? Like you're calling death to your family.
Exactly.
So what do you have to say about that?
Yeah, that's a good question. Now, here's the thing. They say that two things are inevitable, death and taxes.
Yes.
But there's something we can do about taxes. Something called tax planning. I'll talk about it in a minute.
Right.
But death is inevitable. Here's the thing. If your family is living a certain lifestyle, I always say that a family is a going concern. Just because you're not there does not necessarily mean that everything about your family crashes. Right? We have to be responsible. We should not fear death to a point of even abandoning our own families.
Right.
And especially being in the US, we're going to make sure that we're coming up with a plan to protect and make sure that our assets can pass over to our kids, avoiding this probate even when we pass on. I'll give you a case in point.
Right.
There's somebody called the Rockefeller. In 1934, he set up what you call the dynasty trust of the Rockefellers. And then he did this. He said, everything within my family, every time somebody is born within my family, I want my trust to buy a life insurance policy in the life of this kid. When that kid passes on, when that person passes on, anyone passes on, the money is paid back to the trust. And then the family now gets income from this trust, And we are saying, that is the future. That is the future. Us setting up trust funds for our families and making sure that we are creating generational wealth for the sake of ourselves and our future generations.
So is there any money to put in the trust? I mean, like a monthly fee or something like that?
That's a good question. Now, the trust itself is a legal document. So setting up the trust is just legal fees. There's nothing that you pay every month to maintain the trust. But I want you to remember that a trust is like an empty box.
Right.
If you have an empty box, is it going to help your children?
No.
It will not, right? So once you set up the trust, you're going to think about how do you fund? How do you fund this trust?
So utakuwa ukiweka kakitu.
Exactly.
Okay.
Now, there are different ways to fund the trust. If you have money in a bank account, you can create a trust account. In most cases, the elite in this country, how they fund the trust is using index universal life accounts, policies. And what they will do is they will say, I'm going to be buying these policies. We call it trust-owned life insurance. Or I'm going to have a policy I own, but I'm going to name the trust as my beneficiary. Okay. So this one passes on. The money, instead of going to other people, it's going back to the trust. Let me tell you why they do that. If you give $1 million to a kid who is 25 years old, atafanya nini na hiyo pesa? They don't think about what a Ferrari.
I know, yeah.
You know? They'll be like, I'm going to go to Santorini, Greece every weekend.
Yes.
Every weekend. So how you do that is now you make sure but you set up this policy, but then you name the trust as the beneficiary.
Okay, I mean,
so how you paying? Yeah. So the only thing you're paying is the underlying fund for this account.
Okay.
Yeah.
I mean, now someone is asking,
yes,
who are those people who qualify? Do we have age limit if somebody wants to set up that trust? I mean, to avoid the probate. I mean, kuna miaka.
Now, we don't have a limit. Even if you are 65 years old, you can set up a trust.
Okay.
Even if it's a kid who is 10 years, parents can set up a trust fund for their kids. Let me give you the difference. For instance, if it's a kid, the parents can set up a trust fund, and then they can set up a trust and fund the trust using a plan under Section 529. Okay. We call them 529 plans, or they can use something we call a plan under Section 7702. Okay. A plan under Section 7702 is what you call an index universal life account. So what they are doing is that they are contributing money every month. They are contributing every month, and then they have named the trust as the beneficiary for this account. That way, the kid even grows. Let's say the kid grows and then gets married to someone else. In case there's a divorce, they cannot divide this fund because we are saying the fund, the beneficiary is a trust. Is a trust. It's you who set up this account for your kids. That's for kids. Now, let's say somebody is 65 years old. They can decide, instead of owning my house in my own name, because I wanted to pass over to my kids, what I'm going to do is that I'm going to transfer it to the trust for the benefit of my kids. That way, this 65-year-old, in case they pass on, the house now goes to your beneficiaries without going through the probate process. And then they say, within that trust fund, they say, I'm going to take maybe a final expense account. I'm going to take an index universal life account. I'm going to take a term policy to make sure that in case I have a mortgage, that mortgage gets paid and the house passes over to my beneficiaries free and clear. Even if the house is paid, how is the taxes going to be paid? They are saying within the trust, I'm coming up with this plan to make sure that the taxes will be paid so that the house is going to my beneficiaries, making sure that there's enough liquidity to continue maintaining that lifestyle that your family is
I mean, maybe my final question, because we'll set up another interview, is that someone is saying, hey, you want to tell me to put some money in that trust, in that box, then if I want that money back, is it gone? Or can I access that money? Ama sasa ninaweka tu, when nikishindwa kuweka, then my money is gone.
Oh, okay, that's a good question. Again, it depends with the underlying funding instrument. What I mean by that is, for instance, if you are funding it using 401k, you cannot be able to take the money out until you are 59 and a half years old. The only way you can access the money is taking a loan. But the 401k account, the maximum you can take out is $50,000. The maximum loan you can take is $50,000. If you want to withdraw, you have to pay a penalty of 10% plus taxes at 20%. You see? If you fund the same accounts using an index universal life account, then you are able to take the money out tax-free. Okay. So access to cash depends with the funding instrument that you are using to fund this trust. To fund this trust.
I mean, this information you can actually get from Attorney Miano from Dallas, Texas. And I don't even know what Dallas mumeshawaisikia hii maneno. Not only Dallas, anywhere in the States. Saizi kwa Oregon, kama mtu anataka kujua hao kwanza watu wako na manyumba sana. You know, people have set up businesses here. And people don't even, I mean, wengi wanasema mimi pesa ni zangu na my family. But they don't know there is something that can happen. Ifonyoke yote. So they can get rich of you, right?
They can get rich of me. I tell people, if you have an adult family home, you need to have it in the name of an LLC. And then what you do, the LLC, we can create a holding company in Wyoming because it has more asset protection. And then we're going to make sure the money that you are making from your adult family home, we can have it in an index universal life account for purposes of holistic asset protection. But the other Kenya, naambia watu, if you have, for instance, land in Nanyuki, Romuruti, Kitengela, you can create one holding company. And that holding company is going to own your assets. And then you have your family members as directors in this holding company. That way hata ukienda, your asset can pass over to your kids and your spouse or your family members, avoiding all this complexity. Because even in Kenya, when someone passes on, your family has to get letters of administration. And then they have to go to every registry. Every registry you have property. So you can imagine, anaenda Mombasa, they go to Nanyuki, they go to Rumuruti, and sometimes they go there, you know, they are like, they go to the registry, wanapata Kamau. Kamau is one in charge. And then wanasikia unatoeng pale. Man,
watakuchopa sana.
Man. They make sure that you can even get this asset.
Right.
And let me tell you the truth. Sometimes even kids here, they give up. They're like, I'm not going to go chase these assets. And so we have a situation whereby our people are losing assets because they didn't come up with a holistic plan. That's why we're telling people, let's come sit down, look at your assets, we evaluate and come up with a holistic plan to make sure your assets will pass over to your kids, your family, your loved ones, avoiding the probate process.
Hey, tupe number, bro. What's your number?
So my phone number is 412
right
225 3282.
Awesome.
Again, my phone number is 412 225 3282. Thank you so much.
Robert Miano.
Yes.
Ongea na yeye, tutakusaidia.
Yes.
Next time tutaonana.
Asante sana.
Hizo ni information mzuri sana.
Our
people need to know that.
Asante sana.
And mimi naitwa Jeremy Damaris. God bless you so much. People from Oregon, thank you. And I think you'll be around. Nasikia unaenda Seattle.
Yes.
After Seattle,
I'm going to California. After California, I'm going to Arizona. Yes.
Sasa kama uko na biashara, muite mkae chini akuelezea hii maneno na lugha yako yenye utaelewa vizuri.
Kabisa.
Ndio hiyo?
Yeah.
Thank you. God bless you. Asanteni sana.
Asante sana.